The $19 billion wipeout. Why Bitcoin really crashed. Just days after hitting a record high, the crypto market was thrown into chaos. Bitcoin plummeted, wiping out billions in minutes. Was this just a trade war panic, or was something more sinister at play? In this video, we'll uncover the 3 explosive reasons behind the biggest crypto crash in history. Stay with us to learn the full story. On Friday, October 10th, 2025, a single social media post from former President Donald Trump sent shockwaves through global markets. He threatened to impose 100% tariffs on Chinese imports, reigniting fears of a full-blown trade war. Nervous investors immediately fled from risky assets. The tech-heavy Nasdaq index fell, but the reaction in the crypto market was far more extreme. This was the spark, a classic risk-off stampede where people sell speculative holdings for the safety of assets like gold and government bonds. But a spark alone doesn't cause a firestorm. The crypto market was soaked in gasoline, just waiting to ignite. That gasoline was extreme leverage. In simple terms, countless traders had borrowed massive amounts of money to amplify their crypto bets. When it works, the profits are huge. But when prices started falling that Friday, it created a catastrophic chain reaction. As prices dipped, these highly leveraged positions were automatically sold off or liquidated by exchanges to prevent further losses. This forced selling pushed prices down even further, triggering more liquidations. It became a self-feeding loop of panic. In just hours, a record $9 billion in leveraged positions were wiped out, making this the largest liquidation event in crypto history. This leverage cascade was the primary amplifier of the crash. But there's a third, even more disturbing layer to this story. Evidence suggests this wasn't just a market panic, it may have been a coordinated attack. On-chain investigators noticed something strange. Certain assets, like the stablecoin USD, completely lost their value on one major exchange while staying stable everywhere else. This points to an Oracle manipulation attack. Here's how it worked. A malicious actor, or whale, allegedly exploited a known vulnerability. They dumped a relatively small amount of specific assets, around $1 million, on a single exchange to artificially crash the local price. The platform's pricing system, or Oracle, then read this fake price and used it to liquidate billions of dollars in leveraged positions across the entire market. It's believed this single actor had placed over $1 billion in short positions beforehand, potentially profiting over $0 million from the chaos they helped create. So, to recap the 3 top reasons for the crash. First, the geopolitical spark from Trump's tariff threats that triggered initial panic. Second, the leverage amplifier, where a record billion in forced liquidations turned a dip into a free fall. And third, the coordinated attack, where a whale may have weaponized market structure for massive profit. It was the combination of all these factors that created the historic crash. The market has since partially recovered, but the questions remain. This crash was a brutal lesson in the fragility and immaturity of the crypto ecosystem. It exposed critical flaws, from over-reliance on leverage to vulnerabilities in Oracle design that can be weaponized. For long-term investors, the lessons are clear. Avoid using leverage, stick to major assets, and understand that volatility is part of the game. The structural forces driving crypto, like ETF adoption, are still in place. But this event is a stark reminder that the path forward will be anything but smooth. Thanks for watching. If you learned something new, please like and subscribe for more deep dives. Let us know in the comments, do you think the crash was primarily due to panic or a coordinated attack? Check out our other video on how to manage risk in crypto right here.